Good evening, everyone. Good evening to all the attendees in person. Good evening to our panelists, and good evening to all the attendees that are watching this webinar online. I would like to welcome all of you to this event that is being hosted by Regenesys Business School and its investment subsidiary company, MyWealth Investments. Ladies and gentlemen, my name is Annetjie van Rooyen. I'm the CEO of MyWealth Investments, and I'm honored to introduce this panel to you tonight. So they will be giving us a better perspective or understanding about the current hot trending topic of inflation and whether higher interest rates will be enough to contain inflation. So if I can start off with the gentleman here on my right, Craig Williamson is the founder of Bastion Advisory, my apologies. And then we have celebrity asset manager and founder of Cartesian Capital, Anthea Gardner. Anthea, thank you for joining us tonight. Craig, thank you for joining us. And then also very welcome Jonathan Brummer from Riskera. He's a senior investment consultant. We are really honored to have you guys on our panel. And the host this evening is the young and beautiful Charne Olivier. She's a chartered financial planner at MyWealth Investments. And we're going to leave you in her capable hands. But I also have to introduce our financial director to you, Rulien van der Heever. And she will provide us with closing remarks at the end of the session. Rulien, just show your face to the camera, please. We intend to wrap up the session at 6:30. If you are affected by load shedding, you can obtain a copy of the conversation on the website of the Business School as well as MyWealth Investments. And we will also be posting the webinar online on all social platforms. So sit back and enjoy the evening with us. Thank you.
Thank you, Annetjie. It's clear that we have a bunch of very knowledgeable speakers with me on stage, and I really look forward to hearing your opinion on this topic. So without further ado, let us jump in. There's definitely a lot to discuss and unbundle. I want to start off by setting the framework for this discussion by asking a question that will just help us understand how we got here. Anthea, I want to throw this question to you. What were the factors that contributed to the inflation we're seeing at the moment? And I want to ask you to specifically also address how supply push and demand pull inflation also contributed to what we're seeing at the moment. And just for our audience, very briefly, supply push inflation is if we have a situation where the demand for a product in the economy remains the same, but for supply reason, manufacturing isn't keeping up, and that is pushing prices up. On the flip side of that, we have demand pull inflation, which is a situation where the supply remains the same, but the demand in the economy is picking up. And this often happens when there is an increased money supply, like if we have interest rates that are falling, or if there is a lot of grants being pushed out into the economy, or if we have high employment and people have a lot of disposable income, and that creates an increase in demand. So Anthea, I want to just ask you, what is your take on how we got here?
So I would say we probably started post-GFC, the global financial crisis, when the Fed, and we'll talk globally, right? The Fed and many other central banks started issuing what we call free money. They started throwing money at the economy after the global financial crisis to reset it, to get it going again. Their target then was 2% inflation, so they had zero inflation. They wanted inflation kind of to increase and to get to, because a little bit of inflation is good, too much obviously is bad. And so they kept throwing money at it, and it actually didn't happen. It was a very weird situation, very delayed. The economy's opened up. People are going out shopping again. So we've got this demand. People are starting to buy things again. On top of that, we have supply chain issues because of lockdown and because we see things going, especially at the moment with China going into some serious lockdown with their zero tolerance COVID policy. You're seeing a lot of blocks in the supply chain. So you've got people wanting to buy things and suppliers not being able to deliver. Add to that, just for the perfect storm, of course, is the Russia invading Ukraine, and that war hasn't helped at all. Of course, I think you've all seen the stats of how much Russia produces and what it produces, and how when the supply is cut or altered in any way, they have to find a different supply, and the demand remains the same. You see the supply issue.
And I mean the oil prices as well, the whole play where we are hoeing Russia out of the equation, basically, and that is causing commodity prices to increase as well, you know, so there's also some supply chain constraints on that side. So the long and the short is there are two sides to this. There's the demand increasing and it's the supply, you know.
Indeed, so it feels a bit exaggerated because you've got both sides of the coin pushing this inflation higher, and I think it's exactly what's happening, which is so weird because, as I said, when we had the GFC and the US Fed were trying to get to an inflation level, they just couldn't get there, and now they're struggling with hyperinflation, of course.
Economics is such a strange thing.
Careful what you wish for.
I was just about to say maybe not hyperinflation,
Yeah,
right?
be careful.
Be careful of that. We're not Zimbabwe. They're not Zimbabwe yet.
Speaking of scary words in the economy, we've been starting to hear a very scary S word being thrown around.
Look, I wouldn't say I completely disagree, but we've kind of been here for a number of years. We've had the similar levels of unemployment for, shall we say, a decade. Now, that's not a good thing, but we've managed through it. You know, we're still growing, not at the rates we should, and inflation is increasing, so the risks for stagflation, I would agree, are increasing. But I'm a bit more optimistic, I think.
Speaking of the central bank and the South African Reserve Bank specifically, you touched on that. And Craig, we had an interesting discussion the other day about exactly what is their mandate, and it's something that a lot of people actually don't understand. And I want to ask you to just help us unpack and understand what exactly is the mandate of the South African Reserve Bank, and just contrasting that to what the Fed is actually targeting and how they make their decisions and base their decisions on.
Yeah, thanks, Charne. So I think the question about the question for tonight is, are interest rates an effective tool in managing inflation? And you know, there is a school of thought that they perhaps are not, because of the conversation that we've had about supply side versus demand side inflation. But the point we discussed the other evening was that interest rates are not just a tool to manage inflation; they're actually the tool of the South African Reserve Bank. And I did just do a few little slides here, which I don't know if they're here, but let's see. Oh, no. Oh, okay. Oops. Oh, there we go. Okay, so I just did a few little slides, and these will be available to people. But the interesting thing to read is that the primary mandate of the South African Reserve Bank is to protect the value of the currency in the interest of balanced and sustainable economic growth. So their key factor is credibility, that we mentioned earlier, sustainability. Now, how do they do that? And this is just off their website. If anybody's interested, you can go and have a look. I just want to see what where a little button is. Oops. Okay, so if I press it twice, that's what happens. Here, so just of their sort of 5 main mandates, the one is here, maintain headline inflation within the target range, which we have been discussing, is enhance South Africans' resilience to external shocks. And these 2 items are extremely important for the SARB, and it's extremely important the way that foreign investors look at South Africa. So their main mandate is stability in order that we can achieve growth. So sometimes the stability will require us to push interest rates up to give people the confidence in the local economy, in the Reserve Bank, that they can make investment decisions in South Africa, locally and foreign. So that's just the key point I wanted to make about their interest rate policy. It's not just a knee-jerk reaction to inflation by itself.
And it's important because a lot of people think of, I'm paying more for petrol and everything else is getting more expensive. Why on earth is the Reserve Bank putting another downer on me by increasing interest rates when things are already very tough? And the thing that we were saying is we often don't take into account how the currency can also play into that, although it's not a direct impact that you will feel. But if that spins out of control, things can get much, much worse very quickly.
Yes, so you asked about the Fed in relation to that.
Yes.
So they've got a broader mandate, and they've got a broader growth mandate, and they don't need to really worry about financial stability because they're the Fed, they're the US dollar, so they can set the trend. And a lot of commentators will say that they've been very remiss with a zero interest rate policy for these last 5 years, or since the beginning of COVID anyway, and then prior to that, they also had a very low interest rate policy. And they made monetary policy very loose, and so asset prices grew, and the money in the system grew. And as Anthea mentioned, there was no inflation until there was inflation. And now suddenly they've got this inflation bubble. And a lot of people are very impressed with the current Fed chairman, Chairman Powell, because in previous periods of economic instability, you would have had a Greenspan or a Bernanke. They would have come in quickly and suddenly started changing the rhetoric and be less hawkish and more bullish and say, don't worry, guys, we're not going to push up interest rates. But he's not doing that. He's sticking to his guns. And the US is going to have to take some interest rate pain and some economic pain in order to stabilize the economic cycle. And we need to follow that. We can't be out of sync with that because that'll impact our credibility.
I heard the best comment the other day, or I read it, I should say. A presenter was asking Powell what advice he would give to Powell if he was in the Fed chair seat. And he said, now's a good time to resign. I mean, I think his job is a tough one at the moment.
Absolutely. But we touched on this the other day as well, just the political pressure they feel in this. Do you think Powell is suffering any political pressure, or do you think he's actually staying quite level-headed in terms of his decisions?
I think he's staying amazingly level-headed. You've obviously got a president in the US and a government that's got a very low approval rating at the moment. This is not going to help them. So this is where the Fed, I suppose, needs to show its independence.
And it's actually doing very well in that regard.
But I mean, there is pressure, right? As you said,
sure.
Biden has got a very low approval rating at the moment. I'm sure he's facing pressure, but agreed, he's standing up and doing what's required.
So I want to then just let us make it clear what our understanding is of this, talking to the heart of our discussion here. Should interest rates be increased? And should interest rates be used to address the inflation situation? I mean, like Anthea mentioned now, we've got a lot of supply chain issues that is causing this high inflation. And increasing interest rates really doesn't do much to address that. Is it really the time now to start increasing interest rates, and not just internationally in the US, but also from a South African point of view? Why is it important to start raising the interest rates now, especially if economies are already suffering?
Sure. So as a consumer, I think you've pointed out earlier on, when your petrol price is going up, your meat costs more, your mortgage also costing more, suddenly is a burden just too far. But as you pointed out, what we have in South Africa are exogenous factors pushing inflation. So the higher oil price, higher meat, supply chain issues. And honestly, if you are raising interest rates, the point of raising interest rates is to really stop the consumer from overspending or spending more than they should. So you raise interest rates, the consumer feels the pinch, stops buying, stops pushing inflation up. And by the way, the South African economy is over 60% consumer-driven. Consumer spending driven, which is massive, right? So you'd think that it would work. But then to Craig's point, so that's one argument. Then to Craig's point about financial stability, and I kind of almost get my back up when I see, them talking about the currency, because many years ago when I was managing offshore money and the Swiss National Bank kept their currency low. So they wanted to kind of peg their currency, and they used up a lot of their reserves, which South Africa doesn't really have, to keep this currency where it needed to be. That wouldn't work for us, but that, just let me point out, is not the SARB's mandate, right? So theirs is slightly different in that they want currency stability and they want price stability. So now you're talking about PPP, purchasing power parity. And if the US is raising interest rates, which broke my heart the other day when they raised it 50 basis points, what you almost need to do to follow is to raise interest rates, just for that economic or that price stability across the globe. So just think of it in very simplistic investment terms. Money flows to the higher yield or the higher return. So if our interest rates are, our government interest rates on our 10-year, 9.5, call it, right? Correct, 9.5, somewhere there. And the US is 2, and that's kind of that parity, that 7% differential is normal, right, when you consider the currency and where you are and GDP and all that. If the Fed then raises their interest rates by 50 basis points, that differential closes and money would flow to them because of PPP. So we almost have to raise our interest rates to attract investments and for people to buy into the rand to keep it where it is. It's a very weird kind of, why do we have to? But it is how it works. Money flows to the highest yield or the highest return.
And that's the point. Like, a lot of people don't understand all these factors playing in the background, and that the currency is really important for us as South Africans, especially because we're such a small economy, being so dependent on our exports.
Sorry to interrupt, Charne, but just this graph that Anthea put together for us. This is US, for the listeners and the readers, this is US interest rates, which have been, this is 6%, it was pretty high, and then they've boosted them up around the GFC to defend the position of the economy then. And this blue line is South African, oops, oh goodness, there we go, the blue line are South African interest rates. And this is using a 3-month JIBAR rate as a benchmark in order to compare to the US 3-month rate. But it just tells the story that Anthea was describing. There's no ways, as the US brought down rates, we were able to bring rates way down. But there's no ways with them pushing rates up. With them pushing rates up, we have to respond to that, because otherwise money will leave South Africa, the rand will weaken, and the cost of that rand weakening to the consumer will be far worse than 1 or 2% up in interest rates.
I hear what you're saying. That's an interesting point.
I think the point is, like, globalization means we're all connected, and 60% of let's say earnings on the JSE is now offshore. We import a lot of our inflation. So there's that link, but there's also the fact that if you have inflation in the US, that's going to make its way into South Africa, push up our own inflation, and force our own Reserve Bank to have to react and increase rates. So the world is just, a pretty connected place, and you have to stay in step.
I think what is baffling investors or economists at the moment is the inflation differential between the US and South Africa. So they've always had much lower inflation, and now suddenly it's higher than us. And that just has thrown every kind of theoretical academic theory out the window. And so we are still struggling with what next. Like, where do we go from here? And are we going to see that US inflation import, that high inflation, suddenly hit our shores? And that's going to hurt a lot.
But I think you've got to remember the size of the stimulus that the US did versus South Africa. And I think demand is a lot stronger in the US as well, related to South Africa. So that would have pushed their inflation up probably a bit more than ours. It is a strange thing for us. I think you'd see it coming back down again over the next few years. But it's a strange thing to witness. We're not used to that.
The US has some demand pull inflation pulling in there, basically, that we are not seeing in South Africa.
Charne, but the way to look at it as well is if you look at it, okay, we're looking at year-on-year inflation. If you look at inflation, take 2010 to 2022, and see what the compound inflation in the US has been, to compare our compound inflation from 2010 to 2022, ours will be
much higher,
significantly higher. So again, it's this, as Anthea was mentioning, it was like 0, 0, 0, 0, and now suddenly, boom.
Spike.
Yeah, so again, that's a year-on-year figure, or a month-on-month, I don't even know what it is, but you've got to look at these cycles over a long term.
It's also the way the calc works. If you think each new month there's now a new high inflation and a low one drops out. Yeah. So for a while you kind of have the spike before it turns around. But your point around the average over a long period, I think, is true. Yeah.
So the long and the short is, yes, there's supply side issues that's pushing up the inflation, but interest rate needs to be increased at this point.
I think that is a very important point. And again, just to reiterate, I mean, our prime rate currently is 7.75, I think. It's this green line. I'm sorry, this chart doesn't have numbers on it. But, we were living around here at about a 10% prime interest rate for, I can tell you, sorry, Anthea, these years over here, to whatever this is, about 2012, 13, 14, 15, I don't know, something like that. And then this is 2020, where we cut interest rates way down. prime down to whatever it was, 6.5% or 7%. For us to go back to these levels is not. We shouldn't worry about that.
It's not unnatural.
It's not unnatural. In fact, it's natural. This is unnatural. So, I think, and we can hear from my tone is that we need to normalize the economy. And if we're running inflation at 6% or 5% on average, a 10% prime interest rate is a reasonable cost of borrowing against that.
So Craig makes a very good point. Like, what is normal, right? So this is not, where we are now is not normal. And I think it was Jonathan earlier on, or Craig, that referred to the Fed quite comfortable with the US consumers' balance sheet, because that's one of the things they said. They're very happy, the balance sheets in the US, not only the consumer, but businesses are strong, which makes them think that they can avoid a recession, even though, by the way, everyone's talking about it, right? Inverted yield curve, here comes the recession. Whereas in South Africa, I'm not sure that the consumer or business balance sheets are as strong as in the US. And that's the pessimist in me that says, sure, we can push up interest rates. And quite frankly, sorry to tell you all, I don't think we have a choice. But it is going to hurt. So buckle in, folks.
So it's drinking some medicine to get better, basically. So I want to have us move on to, if we look at historic high inflation environments and kind of thinking about the lessons we can take away from that. And two of the most recent, or some of the very recent high inflation historic events was, first of all, post World War II, when, Jonathan, as you mentioned, there was also a supply side that contributed to the high inflation that we saw back then. But we also had the Great Depression in the 1970s, early 1980s, where during that period, decisions were based on the Philip curve that was specifically trying to have a trade-off between employment and inflation. And people were very happy to have this high inflation situation because at least people are being employed. And back then, inflation wasn't understood that well. And then they had an oil crisis that made the inflation spin out of control. And the only way they tried various different ways before they got to increasing interest rates. But at the end of the day, increasing the interest rates was the tool that helped them get to a more stable inflation situation. Is there anything from any of you guys where you, and even other historic events, that you think there are some lessons for us to take away?
Well, if I think about the 70s period, the great inflation, as you said, what was similar is you had very accommodative monetary policy, you had large fiscal spending during that time, and also the similarity is you had this external shock, so oil embargo all of a sudden, supply side constrained severely. Remember also that in early 70s, the link to gold for the US dollar was let go. So that was another big impact that caused inflation. So that kind of is what was similar. What's very different now from then, I think, is the size of the shock. So then in real terms, oil went from $50 to $150. Now we're at 60, went down to 20 during COVID, back now to 100. So in real terms, we're only still 2/3 of the way to where it was. So the shock is not to the same extent.
Relatively smaller.
Relatively smaller, which is going to help. And the other big thing is that monetary policy come a long way. In those days, the reserve banks, the central banks, didn't have a inflation fighting mandate. They wouldn't tell the public, what the rate is that they're aiming for. The monetary policy just wasn't understood. We're now in a place where reserve banks tell that to people. There's regular meetings, they telegraph it, we know what's happening. And they've built up a lot of credibility over the last, let's say, 2 decades. And I think that's gonna help in the fight against inflation. In the 1970s, inflation went up to 15, 16%. No one likes that. That's bad for everything. That's bad for asset prices. We saw 50% declines in the US stock market during a portion of that. That's not to say you didn't have recessions. When they increased interest rates, there was recession. And I don't know if the US is going to be able to get out of having some form of recession. Hopefully it's not too deep, but I think the Fed's a little bit optimistic. Hopefully South Africa, will we avoid it or not? I don't know. But there's got to be pain, as you said. To bring back inflation, you've got to raise rates. That's how you work on the demand side. it's gonna have a negative GDP impact.
I think I've got some good news.
I don't believe it.
You sound as if you know me. So we're talking about kind of the Fed and the South African Reserve Bank predominantly, right? And I've heard stories from the South African Reserve Bank when many decades ago the Reserve Bank governor would kind of sit down on a Friday, have a glass of wine with his lunch, and then phone up the rest of the MPC and say, by the way, I'm raising interest rates tonight. So the fact that our Reserve Bank now tells you when those MPC meetings are going to be, when the announcements are going to be, in fact, they're almost as good as the Fed in telling you what they're doing. So you know where they're going. And while I'm talking about them, the fact that they've staved off this attack on what should be an independent central bank, even though like all the bad news, we need interest rate hikes and it's going to go up, and I almost have a sense of comfort that the South African Reserve Bank knows what they're doing, and they're good and they're independent and thoughtful, and they understand things like how long it takes for the interest rate to take hold in the economy. They understand the global economy and the impacts. So I'm just giving you some sort of comfort this evening that it's going to be okay, I think.
Yeah, and Charne, we haven't spoken about inflation expectations.
And that's an important thing to consider. And it's important to have this transparency from the reserve banks when you start talking about the expectation.
Yeah, and I mean that to anchor expectations is very important. Think about it. If I think prices are going to go up, I'm going to go and ask for a high salary increase. If the company I work for thinks I'm going to ask for a high salary increase, they've got to hike the rates to our clients. And so you get into this vicious cycle. You can't contain inflation. And I think what reserve banks do very well now, to your point, is telegraph what they're going to do. They tell the market. They're trying to anchor those inflation expectations, which is a very powerful tool. If you let that go, then you're in a risky situation. Then no one believes the central bank will step in and do what they need to, that they're targeting a specific rate, and then you lose confidence. Then we're in trouble. So important point. And I don't think we're unanchored yet.
But there is some talk in the US that I've read that people isn't comfortable knowing to trust the Fed in their way of managing the high inflation. Do you think that's something you're seeing? Not really.
Who are these people?
I think the US has got, there
You've
are just so
got
many
comfort.
opinions of so many people. I think if you look at Wall Street trusts the Fed, and that's
are the
really
people
who
we
matters.
need to have to trust the Fed.
I think we need to distinguish between economics and politics. And I think,
That's true.
you've seen it in South Africa as well, right? So I think the Reserve Bank in South Africa, the SARB, is brilliant. They know what they're doing. I've got absolute confidence in them. But every second month you will read about the opposition, one of the many opposition parties in South Africa, saying how bad the Reserve Bank is and it needs to be nationalized, and they don't know what they're doing. So distinguish
Politics
between politics in the US
plays
and
in.
economics and Wall Street.
Absolutely.
Just going back to your point about the history and how, and what's actually happened. Jonathan was saying the 70s and 80s was a long time ago by economic policy. Also then, individuals or the private sector were the greatest borrowers in the market in those years. And so increases in interest rates made a massive impact on consumer spending. Today, we've got the position where governments are actually the biggest borrowers by quite considerable margin over and above the private sector. So when they're pushing up interest rates, they are actually making their cost of borrowing higher, but they're actually more than that sucking liquidity out of the system because they're offering better rates at the central bank. And so the banks take their assets, their bonds or short-term paper, take it to the Fed, or in South Africa, take it to the SARB, and they earn an interest rate for giving them that paper, which takes liquidity out of the market for them to on-lend and what have you. So it's a bit more of a liquidity play than necessarily now we're going to hit the consumer. So that's the one big difference, I think, between then and now. The other thing is you mentioned about the timing, and this graph over here, although you can't see the years, this is 2007, 2008 crisis. And this blue line is the South African repo rate. This is the line set by the Reserve Bank. And this orange line is this year-on-year CPI. Now, I've averaged these every year just to smooth these lines a bit. But you can see quite interestingly, here we were raising interest rates as inflation went up. We were raising and raising and raising. So there was an inflationary push. There was also a defensive strategy because we needed to push up interest rates in South Africa to maintain our US, the previous graph. And as inflation started coming down, we responded very quickly with lower interest rates. And then over this intervening period, we had a few little interest rates. I mean, this inflation rate here is probably around 5%. And you can get these slides and you'll see the actual numbers. And then we kept interest rates quite stable, even though inflation went down to sort of 4%. And now we see it running up. And now our interest rates, we're behind the curve because inflation is rising faster than interest rates at the moment. And that's why we had the previous graph where we're expecting our interest rates to sort of normalize back to these levels. And this is the repo rate, but we shouldn't be surprised by it. And I don't think, personally, contrary to Anthea, it's going to have a massive negative impact on the South African economy.
And it's interesting because what you're basically saying is that the SARB has been very active in controlling inflation. This is now spun a little bit out of control where they're reactive. But the point is they do have it under control. And and you mentioned this the other day as well, that they take an 18-month, I think is what you said, like an 18-month cycle in making decisions. So it's not looking at it just here and now and immediately making a decision based on current situations.
I think it's that the Reserve Bank understands that when they raise interest rates, it doesn't stop you tomorrow from borrowing and buying. So it takes a while for that interest rate hike to filter through. So I was really annoyed with them when they raised interest rates at the end of last year, November, because I didn't think they needed to. Now I'm kind of grateful. So inflation's under control, will be under control.
And that's why they're at the SARB, and Anthea, unfortunately, you are not.
Ouch.
We go way back. Anthea and I know each other.
Craig did this graph, not me.
Setting the record straight. Okay, so inflation is high. We've covered that. Interest rates are increasing. But how should we position our portfolios? Investors are worried. Where do we turn? It feels like the market is a bloodbath at the moment. What are we doing? Where are we going? And all three of you are experts on this, and I would really love to hear all of your opinions. Are we starting with you, Craig?
You can start with me. I'm not an investment professional. I'm not I don't advise people on investments at all. But personally, I think when interest rates are going up and South Africa's got South African investors, we've got the gift of a very robust bond market in South Africa. And we've got our 7, 8 year, 9 year bonds giving you 10% per annum. You can buy them right now, guaranteed by the government. You will get your money back. And I think, as part of a portfolio, I think it's an important cornerstone, which is often not actually used by many. Well, it's not commonly used as, for instance, as the stock market. People are not aware of the opportunity in that market.
He may not be an investment professional, but he knows his investments. I'm inclined to agree, Craig. The bond market is probably the best place to be at the moment from a stable point of view. And as a bond manager, I mean, I could get technical and say it is difficult to manage a bond portfolio or fixed income portfolio in a rising interest rate environment, because if you're buying bonds here and interest rates are going up, you're underperforming where they are next month and then the month after. So you kind of want to be in floating rate notes and the technical stuff. And also in asset management, one of the things we always talk about in our company is there's no such thing as a free lunch, but diversification is the closest you're going to get to it. So don't suddenly kind of drop everything and go buy bonds. Solidify your paper loss basically in your stock portfolios. Be patient. It will come back. The optimists in the stock market generally always win, by the way. The bulls generally win. So we'll go with that. I'm going to take a chance, gentlemen, and say that we all agree crypto's not the place to be. Am I right?
Not for me.
I mean, we did have that conversation briefly earlier.
Not for us.
And I'm not actually totally anti-crypto. I think there is scope. There's a place for it in the market. I think that is a technology that is going to become more prevalent over our lifetimes. I mean, when the internet started, and then we had that massive internet bubble like 98, 99, 2000, and the internet was going to be everything, and then it absolutely collapsed. And then after that it solidified, and the technology was good and people used it, and it's now grown to every day. So I would not dislike a blockchain technology and those things to the internet. However, I mean, we say to everybody, if you're going to invest in it, you must be happy that that money, you must be able to lose it, because there are going to be winners and losers. And just like the internet bubble that happened around the turn of the century, just like that, there's some companies you've never ever heard again. They were huge companies in their day. I don't know, I can't even remember who they are now, but they were the darlings and they've gone. So the winners have survived: Apple, Microsoft, Google, but the rest, Amazon, the rest are gone. So you've got to be very careful when you're betting in that world. So I'm not anti, I'm just cautious.
That's fair.
I mean, I guess I'm not going to say anything exciting here. You know, investments, in my view, done right, should be fairly boring, even though the financial entertainment industry would like you to think differently. You know, seeing the flashing lights and we're up on the day, down on the day. Really, in our world where we advise large institutions like pension funds and medical aid schemes, you know, we have the luxury of it being longer term, which really is what investment is about. If you're in equities for days or weeks or months or even years, you're probably on, you know, you're gonna get a hiding. And so the answer there, I think, is, as we've said, diversification. Over long periods, equities are going to give you higher returns than other asset classes. But I agree, the bond yields on offer at the moment are extraordinary, and should be a significant portion of any portfolio. So it's the pretty standard, boring advice, maybe. And I think you need to look through some of the negative returns that we're seeing now. That's the typical buy high, sell low that most investors fall prey to because you're scared. You shouldn't do that. Just lastly on Bitcoin, I don't think it's an asset class. It doesn't derive its value from anything. It doesn't have any cash flows. So I agree the technology, blockchain, this is an interesting way of using blockchain, but I'd be very cautious.
Just jumping back to the fact that you mainly advise on pension funds. Yes, diversification, but I'm going to put you in a corner here. Where are you going overweight? So I assume bonds then, if you say that you see them as quite... Are you overweight bonds? What else?
I would say we're at weight to slightly overweight nominal bonds. I think the protection relative to inflation-linked bonds is healthy. We're definitely overweight local equities, so we think local equities are very cheap. And then if you look at a market like China, it's probably very attractive. We're not that positive on developed market equity at the moment, so we're probably underweight there. So we'd be looking emerging market China, and our local market really does look attractive.
And real estate, none of you have touched on that. How are you feeling on real estate? In a high inflation environment, people often start talking about real estate.
So it's been an interesting, real estate has taken an absolute hiding, and through, a large portion of it was generated through the sort of government responses to COVID, and it's actually significantly changed the way people work. So I'm talking commercial real estate. And the other thing that really hits real estate hard is it's a highly leveraged industry, 40-50% leverage typically, and they're very much in a fixed interest rate world. So what happened was, just bringing back to this graph, when this is our prime rate, when our prime rate is around 10%, a lot of these property companies fixed their interest rates out for 4 or 5 years because it's sort of a market standard. That's what they do. So not only so when interest rates dropped like this, they were not able to get the benefit of those lower interest rates on their debt because they were largely fixed. So they took a huge hit, and then with all the vacancies and non-renewals, renewals at lower prices. So I think the jury's still a bit out, is have we bottomed there? I mean, real estate's always a good asset class, but I'm not that close to it. One stat I can give you is Growth Point Properties, which are the largest REIT in South Africa. If they stripped out their unlet commercial real estate, it would be the 4th biggest REIT in the country. Just
so they're
growth point.
suffering on their commercial side.
So they are suffering. And the real estate companies have not yet properly revalued their properties down. They've avoided it, and they've used with their auditors and said, you know, this is it's a freak event or a black swan event, so let's not go and devalue all the properties because, you know, we might get through this and things will stabilize. So there's a lot of things to come out in the wash certainly in the domestic real estate market. And said I'm not an investor, but we've got clients, quite a few clients in that industry, and they are, you know, it's hard work.
Nothing from you, Anthea. You're looking at me with such
admiration for the academic question. Because that's exactly what it is, right? So academically or theoretically, property and gold are good inflation hedges.
Exactly.
I'm not sure how that's playing out right now.
Well, it's interesting because real estate, like you said, it's a good inflation hedge. But then you get interest rates increasing. So who wants to buy property in a time when interest rates are increasing? So it's kind of counterproductive in a way.
Well, if the property companies are smart, contrary to what they did, they should kind of fix rates at a lower level, right? And I think they do know that. But I think what drives the hedge component of it is that interest rates are going up when inflation's going up, and so they can increase their leases and what they charge, and that's why it is an inflation hedge. Because you know, so if you're a manufacturer of widgets, you can't always pass that input cost onto the consumer, whereas with property, effectively, you're supposed to be able to do that. And then gold, I don't know. I just can't explain it. For the life of me, I don't know why people buy gold when times are tough.
Just
Can't eat
go
it. Can't put it in my car.
Okay, thanks. So I want to ask you guys the $1 million question. And that is, what do you guys think is in for us for the rest of the year in terms of interest rate hikes, locally and in South Africa? I mean, earlier this week, I think we've all been kind of saying, you know, 50 bips going on in the Fed increases. But now we've had CPI come out much higher than expectations in the US, and people are starting to utter about 75 basis points. What are your guys' takes on this? We'll start with you, Jonathan.
Look, I'm not sure, you know, what the increments will be. In the US, expectations are if we're at 1% now, we should be at 2% by the end of the year and 3% midway through next year. What those increments would be, you know, it might be 25, it might be 50. Depends on how aggressively the Fed wants to react. And 3% would be a pretty high level relative to where we've been recently. So that would be something the market would need to digest. That could be negative for equity prices, but I think it would have an effect on inflation. Locally, I think expectation is probably, Craig, you were mentioning it before, we get up to 6, 7, 8% maybe. I think we would have to see what happens. I'm going to be careful and not hazard too much of a
You're not
a
putting any eggs in a basket for that one then.
No, I think it's tough to, you know, if you look at anybody trying to predict, those are mostly wrong. I think what we know, we're in a hiking cycle, and that's going to continue until we see inflation moderate. And then I think the Reserve Bank would, you know, maybe pull back a bit.
Craig?
So over here, this is our, just to go back to, this is US interest rates. These are ours. This blue line is currently where we are. So we've got these two lines here are sort of a Bloomberg sort of average forecast for interest rates for the next 2 years. The red line is the median forecast from Bloomberg of South African interest rates. So currently, and it's not easy to read, but that's taking our large JIBAR rate to about 6%, and the negative view is maybe 7%.
So that's prime up 3% from
Well,
here.
no, we had to, so currently JIBAR is at about 450.
Yeah.
So that's going up 1.5%. That's the median view is 1.5% over the next 12 months, and the negative view is probably 2.5% over the next 12 months. So if prime's currently 775, let's say 950 in a year's time, and outside chance maybe 10.50. And again, all that is just taking us back to these sort of levels where we were. So it's really important for people not to throw the baby out with the bathwater and get panicked because interest rates are not staying at these levels that were only put in post-pandemic to ease the burden on everybody as they so just going back to normal should not be a surprise to people.
Craig, you and Jonathan are definitely our two optimists in the room tonight, so I'm very thankful that there are some, and I think Anthea, you called yourself the pessimist. So.
But I think the point is that it has to happen now to avoid it having to go much higher later.
Yes.
You know, and that's the important thing, is we've got to just manage it. And I like your chart because it shows how nicely the SARB has been managing inflation and interest rates. If they stop doing that, all of a sudden you've got massive spikes, and then you have to act, overreact to try.
As Anthea says, you know, she's very got a lot of faith in our SARB, and we all do. I mean, that, you know, we going back to 2015, you know, I'm generally bearish South Africa. I mean, generally bullish South Africa. That's, you know, very generally bullish. You know, there's a very famous quote, and I mean, this was made in like 1940 or something by, you know, General Smuts, who, you know, may or may not be a friend of the current government, but he was a very significant leader in South Africa and in the world, actually, then. And he is quoted then by saying, you know, South Africa will never be what it can be, but will never be as bad as it could be. And
that's an amazing quote.
And it from back then, you know, so, and I think that still holds true. So we take comfort in the SARB, and just going back to when I did lose my faith, and that was the Nenegate saga in 2015, when Nene was our finance minister and he was fired. And I actually had to start apologizing to my friends because I was saying to them, listen guys, just hang in there, we're going to be fine. That incident would have been the end, and that would have been the end of the SARB, and we would not be sitting here in the position that we are now. So that's how important this independence of the SARB and having a strong finance minister is. Whatever else the rhetoric is, and Anthea mentioned the politics and people shouting from the rafters, if that core is strong, we will be okay.
Okay, well, there you have it, folks. We will be okay. Interest rates will go up. We will suffer, but we will be okay. We've got time for a few questions from the audience. I think questions, if anyone online have questions, if we can maybe post them on an email to our speakers, but our time is just running out. Is there any questions in the audience here?
Hello, good evening. My name is Wayne. Just a question. So you've spoken about the SARB and you know, your faith in the SARB and their track record, etc., etc. But if we view it from the government point of view, let's say from the finance minister point of view, what do you think their response is going to be to the inflation, given that government is probably the largest employer in the country? You mentioned probably one of the largest borrowers, if not the largest borrower in the country, and with long-term rates potentially shooting out as well. What do you see the response from the government side to inflation?
Well, I certainly hope that they will constrain their spending. First of all, in South Africa, the government is not the biggest borrower. It's more of a US and Euro phenomenon now. But I hope that they can constrain their spending. I mean, there's been a lot of talk about changing to a bottom-up budget process for a long time. It's so important because we've been running on a budget process in South Africa for a long time that actually just takes the prior year budget, adds 10% and gives the departments their budgets without actually somebody going from the bottom and saying, what do we actually need? However, I don't have a lot of faith in that process. So, yeah.
I think you have to add to that it's an election ruling party year, right? So they're very much focused on themselves and what they're doing and how they're going to get votes. So of course they are going to kick up a fuss, and of course they're going to have a lot to say to it. I think it might be worth remembering that the governors and deputy governor of the Reserve Bank are appointed by the president, but they don't work for him. So that's kind of like, hold that in your head for a bit.
I mean, maybe if I could just add one thought. You know, government wants to have money to spend, but inflation affects the poorest people in the country the most. And so they have to protect those people as well. So it's also politically in government's interest to make sure that prices remain stable. So I think there's a healthy tension there, and from what I've seen, there seems to be good cooperation between government and the Reserve Bank. I don't think they fight now. Yes, they don't fight too much. I don't know if that's kind of, you know, what your question was after, if you're seeing it differently.
No, I think it's just that I assume there's just as much pressure on the government. You know, inflation, obviously we experience it as individuals in the so-called Main Street, but, you know, I'm sure government impact is there as well.
Thanks, guys. I think we're going to have to wrap it up. Our time is just running out. I want to hand over to Rulien. She's our financial director at MyWealth Investments, just to handle the closing.
Hello. I'll stand you next to you. There's no other way. So before we close off, we have a very special gift for two of our attendees. What I have here is we obtained 2 copies of a book written by our celebrity guest this evening. Where's Annika? Oh, there you are. So the book's name, sorry, I'm just going to show you. Okay, I hope the remote attendees can see this. The book's name is Make Your Money Work For You. It was written by Anthea, and if your objective is to achieve financial freedom, this is definitely a must-read for everyone. So what we did, we were a bit scallum this afternoon, and we had time to play before we came here. So we went ahead, and in the interest of saving time, we drew 2 names from the list of attendees, very randomly selected, but the process was properly witnessed by an auditor. So if you just bear with me, I'm going to get the names quickly. Okay, so the first attendee winning this lovely gift is Sanette Brevard, and the other one is Jenny Chetty. So we will have this delivered to you as soon as we can then. And then, yes, it's my privilege and honor to thank you very much from the bottom of our hearts for attending, for this lively, informative discussion, the pessimistic and optimistic views that we had. To our panelists, Craig, Anthea, and Jonathan, thank you so very much for coming here, for entertaining us. It was really, really very informative. And then our star in MyWealth, Charne, thank you for all the effort that you put in. It was really wonderful. We learned a lot. I think it was very well organized, and we must really give you accolade for this. So can I have a applause for them? Thank you so much. Just from a logistical point of view, there's snacks after this. The people at home, you put the kids to bed and then go and get yourself a glass of wine. We're going to socialize a little bit. So what I just want to ask is if Annika can come and just join me in handing a gift to our speakers, all of them. That would be wonderful. And thank you. Drive safely if you have to drive. And thank you for attending. It was really lovely having you. Thank you all.
Thank you.